All right, welcome everyone to another installment of The Way It Is, and I am your host, Luca Andolfato. And today I am happy to be joined by Professor Hugh Lloyd-Ellis, and he is a professor in the economics department at Queen's University. He has over 25 years of experience conducting academic research in a broad range of areas, including economic development, growth and inequality, economic fluctuations, fiscal policy, and housing. His research is regularly published in leading academic journals. Hugh has taken on several administrative roles, including department head, and teaches development economics and macroeconomics at both the undergraduate and graduate level. He is also an academic economic advisor for Limestone Analytics, where he has recently worked on projects related to international trade and food security in East Africa for UASAID. You'll have to tell me what that acronym stands for after Hugh. And employment impacts of development interventions for the World Bank and the economic impacts of COVID-19 in Ontario. So, Hugh, thank you for being here.
No problem. Nice to be here.
Well, and I it's funny how this happened. I've been doing this podcasting thing for just over a year now, which is hard to believe. And, at times topics come easy and other times they don't. And I was with a group and someone mentioned, you should get an economist on and talk about what's happening in the world these days and how it affects Kingston. So one thing led to another, and here you are. So I'll start the conversation by, obviously, what triggered this is the world we live in today and these inflationary trends that are existing now. And maybe can we just even dumb it down for me and for the listeners? What exactly is inflation, and how does it come to be, I guess?
Okay, so I guess typically we think of inflation as a general rise in the cost of living. All the prices in the economy are tending to move together and they're going up. We always have a little bit of inflation in the economy. Typically, until recently, it's been, since the 90s anyway, it's been around about 2% a year. So prices on average are growing around 2% a year. And that's usually seen as a reasonably good thing. And there's a set of reasons for that. But so prices tend to rise, but not too fast. That's generally viewed as a reasonable way to things to go. The problem is if we expect prices to fall a lot, the worry is that people will stop buying stuff now and wait till later.
Right.
And that could create problems. So that's why there's usually this view that a little bit of inflation is good. But obviously, in the last little while, in the last year anyway, inflation's suddenly rising much more than it has in the recent few decades.
And is it strictly a supply and demand coming out of COVID? Is it strictly supply chain related? What other factors do you think are contributing to that?
Well, like everything in economics, it is supply and demand at its core. Although, for certain kinds of prices, there could be other things going on. And we'll probably come back to that when we think about housing. But in terms of just goods prices in the economy, yeah, I mean, we usually kind of distinguish between factors that drive inflation, like cost-sided factors. So we have this term cost push, the economists use, which basically means supply-side factors. So supply chain problems, as you mentioned, after COVID, it shouldn't be surprising that kind of inventories got depleted. A lot of production capacity in the world went on hold for a while. Even right now, and although we're coming out of some of these restrictions and hopefully that'll continue in Canada, in many parts of the world, this is an ongoing problem. And a lot of our raw materials and resources coming from different parts of the world where they still have pretty tight restrictions. So there's a lot of supply chain problems. There's other things, that's driving these prices in Canada in particular. There's fuel costs, as we've seen. And, there's always a question with gas prices and other kinds of fuel, whether this is a persistent phenomenon associated with rising costs associated with, difficulties in obtaining fuel of various kinds, and also policies that are pushing resources away from fossil fuels and towards,
right.
reproducible fuels. fuels. And then another factor that seems to be important in the last little while, which is particularly, I guess, is you guys. The housing transactions costs have been very high. So what I mean by that is not necessarily the prices themselves, but all the things that associate with transactions that are kind of related to prices. So, as the prices go up, there's a proportion of that associated with transactions costs of various kinds, legal costs, all of those things, real estate costs, and they've been going up, and they're quite a large proportion of the overall cost of living these days. So that's kind of another factor. But then on the demand side, there's a lot of other stuff going on, as we know. I think the big factor which is difficult to kind of define exactly, but it's essentially pent-up demand. Everything was put on hold for most of last year, and we saw it especially in the tourism industry in the summer. At the end of the summer, things just went crazy for a while. I mean, I actually went out to Vancouver. We were talking about Vancouver. We went out to the BC last year last summer, and you couldn't find anywhere to stay. Right, if you left it too late, everything was really expensive. So there's a lot of demand, which is in many ways a good thing. But there's also been this massive government stimulus happening during the pandemic, which was necessary, to maintain people's incomes during that period. Many people have argued maybe it was over the top a little bit, but it certainly had some positive outcomes. But of course, that's meant that there's a bunch of government money that's been pumped into the economy, and it's been there for a while. It's starting to wind down now, but it's still there, and that it stimulates demand. And then, of course, finally, the other factor, which has been true for a little while, but especially true during the pandemic, was the very low interest rates, like phenomenally low interest rates.
Yes,
that essentially was deliberate to kind of maintain liquidity in the credit markets, etc., during that period. But it fuels borrowing and it fuels consumption. So these factors are all contributing to inflation, and it's happening not just in Canada; it's global. It's everywhere because all these countries have faced the same set of factors.
Well, and when I started this podcast, and I sound like a broken record because often I refer to these. It was it was the start of the pandemic, the onset of the pandemic, and I've said this to anybody. Embarrassingly, the pandemic's the best thing to ever happen to real estate. I mean, that's recorded. It's the best real estate market in the history of real estate in Ontario, in the country, and I think I'm seeing a trend now, coming out of the pandemic, meaning, obviously higher vaccination rates and less restrictions and people traveling more now. But in the beginning, I think the demand there's always, these rising prices haven't happened in a vacuum. I mean, this has been an ongoing trend for the last decade. I can track it in terms of lack of supply and increased demand, and it's trackable. There's data on it on every year. The decrease in inventory levels. That's a global phenomena. But in the beginning of the pandemic, it was more centered around people wanting to leave the larger centers because of the unknowns and not wanting to be amongst a large group of people, given what's happening with COVID. And so we saw this migration. We saw people buying properties, different kinds of properties, recreational properties, country, rural properties. Now I see, though, because in the last month, 2 months, we've had an incremental increase in rates, not necessarily noticeable per se, but incremental enough to, all of a sudden a 5-year rate isn't under 2% anymore, but you can still get a variable rate under 2%, like at 1.35 or something ridiculous like that. But now I think the shift has become where the demand side is saying, hey, listen, regardless of where pricing's at, we can't trust where rates are going to go in the next quarter, in the next 6 months, in the next 12 months, we better get into the market now while we can get into the market and take advantage of some of these rates. And we've heard reports just recently on the news and everything that investors are starting to take up a larger section or piece of the pie in terms of acquiring real estate, thereby, being a detriment to people having first-time buyers or other people trying to get access to housing. So I found that that's been a bit of a shift now coming out of this, going out of this year and coming into the start of 2022. So,
yeah, I think this issue about investors, like speculative investors, coming into the markets. I guess the CMHC had a report on this today, or maybe yesterday, was it? The Bank of Canada, Paul Beaudry at the Bank of Canada is one of the deputy governors there, has been talking about it recently as well. And so I actually haven't seen the data on this. It's one of those things it's hard to measure. But I know when I've talked to other real estate agents in Kingston in particular, they've observed this phenomenon happening. So I guess there's an anticipation of future demand in certain areas like Kingston and other places in Ontario, and so people have been buying up real estate, and that's fueling some of this. I don't know how. It's hard to know what's driving what exactly, but it seems like it's a phenomenon. Yeah.
Well, and I operate a property management company. I've done so for as long as I've done real estate here in Kingston, so over 30 years. And I know, I deal with a lot of investors, and I have a lot of clients that are absentee landlords and landlords or investors that don't operate, like that live in other centers, some from the GTA, but far and wide. What's happening in Kingston, as far as the investment world goes, though, and I saw this happening a few years ago, is that Kingston, fortunately, or I guess, people were getting priced out of their marketplaces, right? So the GTA, with the price increases and the math that was going on in terms of returns and capitalization rates, people just couldn't afford to buy in their marketplaces. So then they started looking further afield, Kingston being one of them. And then what augmented that in Kingston was simply the fact that we have, at one point, 2 years ago, pre-pandemic, we had the lowest vacancy rate in the province at less than 1%, 0.7% or something. I think now it's crept up to just maybe under 2% or something like that. So we still have low vacancy rates, and I dare say we have some higher rental rates than other parts of the province, including the GTA, which is shocking for some probably to hear. So it makes it a bit of a perfect storm, if you will, of variables that are contributing to people looking at Kingston as a place to invest, right? Because you can buy a residential home, you can secure a good tenant, you can get premium rents, you can get premium tenants, and then it's easy to look after, right? Because the world has taught us that you don't have to be in the city that you operate in to own an investment property or anything else, right? So,
yeah, in fact, myself and some colleagues at Queen's have been doing some modeling of some of this stuff, housing markets in the biggest cities in Kingston in Canada, but we've included in Kingston in that, even though it's not that big. But one of the things that distinguishes Kingston from a number of places in Ontario in particular is up until maybe 4 or 5 years ago, maybe a little longer than that. It was a place where in most places it was house prices growing relative to rents, essentially. In Kingston, it was a little bit the opposite. Rents, especially down centrally in Kingston, as you say, rents have been growing much relatively rapidly, compared to house pricings for a little while. But that's switched. I think, and you probably just said this as well, 4 or 5 years ago, it started to switch. And now, in the last year or so, that really has switched around. Rents are still growing, but the prices have really accelerated in comparison, and much more than one would usually predict based on the fundamentals. All these places are growing. Populations in a lot of cities in Canada are growing. we'd expect real estate costs to rise as a result. Especially when supply takes a little while to catch up, as it were.
Yes,
is what's happening. But in the last year or so, we've seen this acceleration, as you said, in house prices. And one thing I should mention: house prices don't directly impact measures of inflation, of price inflation of goods and services. In a sense, they don't. So, we include the costs, the mortgage costs, and the the rent costs in these measures of inflation, but it takes a little while for that to filter in, right? So the mortgages are, the average mortgage at a point in time reflects all the mortgages from the past that were based on prices in the past, right? So it's kind of a lagging indicator. So it takes a while for those house prices to filter in. So in a sense, it's not that the inflation, overall inflation that we see now is not so much a result of house price inflation, although there is a factor, as I mentioned before, of the housing transactions costs are affecting inflation.
Yeah, so I was I was going to come back to that because it's a sensitive issue for us as realtors, of course, because we've been called out during this increase in this housing boom that's going on, and even CBC did that marketplace thing that I called out there a few weeks ago. But how realtors are, obviously just sitting around getting these big fat paychecks simply because the house prices are going up, and everybody feels that's undeserved, whatever. But I mean, ours is a direct correlation simply because percentages. It's a percentage of price, and as the price goes up, it's just the percentage of that increase. But
and there are periods when the opposite is going on, right? So.
Well, I've been in it long enough, Hugh, that I've seen it. Sadly, nobody. That's what I was yelling at before. Is nobody remembers the '90s when it took 120 days for a house to sell, and you had to anyway. But when you say transaction costs, like, are lawyers increasing their prices? Because lawyers set their fees, right? So legal fees are set. I mean, land transfer tax is a set sort of formula. So that's the part I'm not understanding, I guess, when you mention these costs associated with the real estate transaction.
Well, it's basically anything that's proportional to the price of the housing. So it wouldn't be things that are fixed. Although, I mean, as prices start to rise, I mean, it's not. I guess there's more. If there's more activity, there's more transactions taking place. Even if the proportionality is not there, even if it's a fixed price, the number of transactions still increases. So that increases the share of this part of of costs in people's overall expenditure, right? So I think that's part of it.
Okay, fair enough.
I think we certainly see it's not just the prices, the fact that there's been a lot of turnover.
Right.
The last year. So that's in fact probably more than the amounts going to real estate agents. I think that's a big factor. So
getting back to this inflationary levels, and we're now, you said sort of a normal expected 2% a year is sort of something that's always there and expected because the cost of goods always goes up, right? I mean, that's just the way of the world. But now that it's at 4.7 or hovering around there, I think, I can't remember what the exact number is, but is that an unhealthy number?
Well, it was 4.7 up to last month. In the US, they've gone over 6% now, so it's significant there.
So apart from it's becoming alarming, or maybe sort of noticeable, not quite alarming, when do the alarm bells start ringing, or when does this? What's a sustainable level, or this can't sustain itself? Speak to that, maybe.
So, I mean, if you look at it from the point of view of the Bank of Canada, I mean, maybe that's what you're getting at, is when they start to worry about it. I mean, they're already worrying about it. In many ways, they've already said this to some extent, is that the bank kind of should be raising interest rates already. Right. Now, you said that the rates are going up in the markets, like mortgage rates, but the actual policy rate set by the central bank hasn't actually changed yet.
Right.
And so it's really the mortgage. It's the sort of longer term mortgage, or the fixed rate mortgages, that are anticipating that there's going to be rises in the variable rates later on. So they want to They want to be in on that. So I think that's what's happening. But the bank hasn't done so, and it's hesitating to do that. I guess there's a bunch of reasons. One is the global economy is still kind of flat foundering, as I said, and this is likely to get worse, I guess, over the winter if COVID spikes in a lot of countries, for example, in Europe. And then, the government stimulus, as I said before, is being wound down, and that could impact things quite quickly if people aren't able to get the same levels of incomes they were doing. And there's a big debt now, and this is this is going to potentially mean new taxes, program spending cuts in the future. And once people start thinking about this or worried about this, this could have bigger negative effects on demand. So these are kind of the worries that the bank is thinking about when it's hesitating over this. And they're worried about the impact on recent home buyers too, right? So if they raise interest rates, so then they've been worried about that for a while. But mortgage debt has accumulated recently as well.
Right.
Even though it's slowed for a while, it rose. So these are all kind of fueling I guess what I'm saying is we should already be worried about inflation. The bank is already worried about it. It's just that there's a lot of other reasons why it doesn't want to raise interest rates yet. And this is happening in the US too, right? So another problem the Bank of Canada faces is it can't raise its rates too high relative to the US too quickly because it's going to affect exchange rate, and there's all these other things going on. So the US is putting this off, so Canada's putting this off as well. They're kind of facing similar problems. But the problem is the longer you put it off, the worse inflation's likely to become.
Right.
Because even though these other factors that were driving it in the first place may be, losing their steam a little bit, hopefully, people are already building these kind of expectations of future rising cost of living into what they're doing now. So you're starting to see a lot of wage contracts feature, increases in the cost of living component, supply contracts. I mean, the Canadian Dairy Commission just read. Thinking of this because I just read in the paper, they just raised their farm gate prices for milk, by 8%, right, or more. So this is partly reflecting the fact that dairy farmers are worried about their own cost of living, and so they want to make sure that their incomes are going to, satisfy that, etc. So there's this potential for a wage price spiral. This is the word people use. It's kind of happened before, and so the point is that there's a problem in that the longer you put this off, the more likely it is to happen. And so when you do start raising interest rates, you might have to do it quite rapidly and significantly to really counteract inflation if you want to get it under control. And it's kind of a long story there, but that's kind of the issue there. So we're not so worried about the inflation rate as it is today, but it might be, it's good to get it under control early, before it kind of gets out of control.
Right.
That's kind of the
No, fair enough. And so, we certainly talked at a macro level. So drilling down to a micro level now for Kingston, what are your, what modeling have you done for Kingston, or where does Kingston stand, or what trends are you seeing happening in Kingston vis-a-vis its economics, vis-a-vis, coming out of the pandemic and these inflationary trends, and, what insights can you provide, I guess?
Well, I mean, in many ways, the implications for real estate markets, as you're no doubt aware, are often very ambiguous, right? So, in some respects, real estate is often seen as a hedge against inflation, right? So, and in fact, that may be one reason why we've seen people investing in real estate more recently. But on the other hand, rising interest rates, as we know, is going to raise mortgage costs, and ultimately, if they rise enough, they're going to stifle demand. You would expect. Now, the underlying, like I said before, the underlying demand for housing in Canada, in Ontario especially, and especially places like Kingston, I think is pretty solid, right? It's population growth is trundling along. And the pandemic seems to have added to that in the sense that, people, as you said before, people are thinking about moving to smaller towns in Ontario potentially. And all of this seems to be outpacing supply still, as the constraints on supply, as we know, have been there, and they're a big factor in Canada. And I think there are new policies that are being introduced that may relieve that, but at the moment, that seems to be the case. It's hard. It's basically, I mean, the one way to look at this, it's if you look at all the factors that kind of drive supply and demand, the fundamentals, basically, it's hard to explain what's happening in Kingston and many other smaller Ontario towns based on those things. I mean, and some of this predated the pandemic. Right. I mean, it's not just, but I think the pandemic's accelerated it. I mean, the CMHC was anticipating a downturn during the pandemic.
Exactly. I know. They
that never happened, right? And
somebody dropped the ball on that one for sure.
Yeah.
But anyway.
Well, I mean, it did slow down a little bit, but then went boom, right? It was crazy. But with raising interest rates, when and if those happen, we'd expect that to cause a slowdown. But I guess the issue is, and as you mentioned this before about the speculative investment going on, if that's being driven by an anticipation of future price rises, and people are buying into this and buying housing now and sort of driving up the price, then you have a situation. I guess we have this self-fulfilling expectation problem where the prices now start to reflect what people think is going to happen in the future, and this is usually. That's not a fundamental factor. That's kind of a bubble, right? That's a speculative bubble that they're worried about. And, we'd expect in response to interest rates, there might be some correction in the markets. But if there is a bubble, then we might get more than a correction. You might get a crash, right? I mean, that's the worry, right? That's the...
Yeah. I mean, I've told everyone from day one that this isn't a bubble. And I still believe, based on everything we've discussed today, that it's still not a bubble. And that is simply because supply will never outpace demand, just simply because it just physically doesn't exist. They're not building enough of it. They're not creating enough of it. And I keep hearing people saying, "Oh, if interest rates go up, it's going to be disaster. People are going to be handing their keys in." And I bite my tongue because I don't want to get into the arguments and I don't want to have the debates. But the bottom line is, what people fail to realize is that there's already a safety net having built in, because we have the stress test. So people are already getting qualified at a 5.25% or 5.45% interest rate, whether they choose to take whatever rate they want to take. Notwithstanding the fact that if rates go up, the only people that's going to hurt are those trying to still get into the marketplace, because now it's going to reduce their buying power, right? But those that have locked in, it will affect the speculators. There's no question. Those that are trying to ride a wave and ride the variable rate or whatever, but then they still have the option to lock in as the rates go to rise. So I don't see that sort of sky is falling scenario happening, that if rates, and let's understand this too, and sadly I'm old enough and been doing this long enough to know that, I mean, again, when I started, the average 5-year money was 12% in Kingston. We're not going to hit 12%. If we hit 12%, then we got bigger issues in the world than anything else to worry about. So, exactly. So, I mean, not too long ago, the fact that people and this is the problem, right? People get spoiled so fast because, money under 5% is still exceptionally cheap money, right? So, I mean, that people got to put that stuff into perspective, I find. So,
I think. Sorry, go ahead.
No. I guess. What are your projections then, or what do you first? I mean, obviously we don't have crystal balls, but I am going to put you on the spot. I certainly won't hold you to account for it. But what projections or what trends do you foresee happening in, let's say, ending 2021, first quarter, heading into like the first 6 months of 2022?
Well, let me predicate this by saying a lot to unpack there. But as you say, basically, people have been predicting Canadian house price, market crashes since the last one in the early 90s, basically, right? And it hasn't happened in the last 30 years, basically. And we've had, recessions and booms, housing crashes in other countries, other major crises, and Canadian house prices just trundle, most places anyway, just trundle upwards, basically. They slow down a little bit sometimes they get ahead of fundamentals, and then they seem to correct themselves gradually. That seems to be how things have gone. So the question really is this time different, right? And I would say, in a qualitative sense, not really. I mean, there's a lot of there's a lot of periods. There's been periods where there's been speculation. I think in the past, things have got ahead of themselves, but then the prices slow down and things catch up again. You move back towards the fundamentals a little bit. I would say, however, just from a quantitative point of view, that this recent acceleration is even proportionally much larger than a lot of what we've seen before, right? So
yeah, fair enough. Yes.
And so that makes me worry a little bit. I mean, I've been, when I've had colleagues come to Kingston and ask should they buy now, should they sell, rent for a while or buy, and often I've said you probably shouldn't buy right now, and I was totally wrong, right?
Shame on you. Shame on you.
So I am not going to engage in studying the tea leaves, but I will say, because I'm invariably wrong. But I mean, I could show you a graph if that would help. Is that something that I could do on this?
Yeah, absolutely. Yeah.
Quick graph. Can you see that?
Okay. Yes.
So this is, exact. So the blue line here is the MLS average price in real terms, like adjusting for inflation of goods and services. Okay. And the red line here is a forecast based on our modeling of fundamentals. So this goes back quite a ways, back to the 80s. So you can see that early on in the period there, we've got the period where things got out of whack, prices got high, went above fundamentals, and then collapsed. They fell, right? Into the mid 90s, and then kind of the reverse, and then basically during the early 2000s, things have trundled along at the right rate. And it's just since, say, 2016 where things started to go awry. And then after that, 2018, in the most recent year period, our modeling would suggest that we're way out of whack.
Yes.
And so the question is, what does that imply? And this is happening. It's not just in Kingston. This is a lot of smaller Ontario towns in Ontario. Right. And Toronto kind of is a little bit out of whack generally, but
well, it always is there, yeah.
But so this makes us think the speculation story may have some value to it, and that
So basically, in a worst case scenario, we're going to see some form of correction getting closer to your modeling line than what's happening in real time. Then, right? Is that potential? The potential exists for that. Then,
if our model is a reasonable model, of course, and we think it has been over the past periods. It starts to it's making us wonder what's going on here.
Yeah. No. Fair enough.
Yeah. Fair enough. So now, whether this would mean a crash is another question, but it could be a slowdown. It'll take a while to ease off, but this big movement is just bigger than it's been before, right? So that's
I certainly will. I concur with that, and I certainly won't argue that point. Again, it's been unprecedented. There's absolutely. I guess for me, and I'm going to. Thank you. I'm going to. And I don't want to keep you too much longer because I know your time is valuable and everything, and we've covered quite a bit. But, for me, I guess, and I've mentioned this in other previous podcasts too. I mean, we've seen appreciation levels at upwards of 40%, 30%, 20-some%, and then even now. So, and what bothers me all the time, though, is that people just they hear things and then they just hold on to these sort of sound bites, in terms of rising rates or crash or a bubble or whatever. And nobody puts, like, I get frustrated when nobody really puts things into perspective, because let's say things start to adjust or correct themselves, right? And we don't see these increased levels. Because I at some point in time, I don't disagree with you. It can't sustain itself. I don't think it can sustain itself. But that being said, what's in real terms, does that mean that now instead of 20%, houses are going to go back to going up by 10%, or 5%, which is still not, that's not a horrible result, right? At the end of the day.
That forecast line is a growing line, right? I mean, so it should be right. The prices are rising because people are moving to Kingston, right? And the supply is constrained a little bit. So the prices should be rising. The question is that's why I'm saying it's not a qualitative kind of issue; it's a quantitative one.
Yeah,
and it just seems that they've risen a lot more than would be predicted by these fundamentals. That's basically what we're saying.
Yeah.
And it could be that a whole bunch of people move to Kingston next year, and I'm totally wrong. But I can't imagine it'd be that many, enough people that it would create this big spike. But anyway.
So two things, and then I because now you just made me think of another question I had earlier. The one variable that doesn't make the headlines and no one seems to talk about, that I still feel is going to be a factor in the country, in Ontario, eventually to Kingston, I would have to guess, immigration. No one is talking about immigration levels moving forward, which I'm made to understand are going to bust at the seams. So, and these aren't people that, whenever you say people are immigrating to the country, people always have the wrong perception that it's unskilled labor, and I'm not saying that's not a proportion of that, but it's going to be highly skilled labor, skilled people coming to
selecting these people. Yeah.
Right. So, I mean, that's going to still shore up demand, right? I mean, that's got to play a role in what's going to unfold. And
I totally agree. So that is something, you're right, that it really doesn't, I mean, people are kind of aware it's going on, but in the last little while, especially under the current Liberal government, there's been something like 400,000 people a year immigrating into Canada, and that's a lot of people. I mean, that's the birth rate in Canada is not enough to sort of offset or keep the population growing, but that immigration rate is really significant, and so that is, and it's accelerated over previous years. So I do not doubt that is a big factor driving rising rents and prices. And that is incorporated into this forecasting thing, right? So, but for a town like Kingston, we're not the first place of location for many people,
right?
But maybe we'll become so over time, especially as a result of this pandemic. But I think, I think one of the things, it's not just the pandemic itself, it's the recognition that you don't have to live in a big city, basically, to do your work.
That's right.
And I think that is a big factor now. And hopefully that will persist. Well, I suspect that will persist. So it could be that this group of people are moving, or some fraction of them anyway, are moving into other areas. And that, for a town the size of Kingston, you add 5,000 people. That's a big chunk of people.
That's a big number. Absolutely. All right. One last thing. I'm going to not put you on the spot per se, and I don't want to cause you to feel nervous or anything like that. But we've heard, because we had the election and the sound bites and the lip service that every party paid to dealing with this housing issue, the housing crisis. That as an economist, is there a role for government in a free market economy, in the housing market? Should they do something? Should they not do something? What are your thoughts on policies going forward?
Well, I guess my general reaction is basically that the biggest problem, it's come up in this discussion as well, for most cities really, but including Kingston, is the rate of increase of supply of housing, basically. We know this is true. We've had an affordability crisis for a while, really, for many people, especially poorer people in the city. And we know, there's been a response to this. We've seen, the increasing number of what do we call them, apartment buildings in the city and stuff. And I think that's great. From a government point of view, they should be doing things to stimulate supply and not demand, right?
Right.
So much. Although, obviously, the demand is, like you said, population growth is going to take care of demand to some extent anyway. So I think that's a big factor. And, I know there's a lot of issues about increasing the size of buildings, for example, in Kingston and all this kind of stuff. And I can see that. I live at this intersection you can see behind me, which is affected by this potential Capitol building, for example.
Right.
And size matters.
It certainly does. Yes.
But I think that this is something we've got to get over. Not necessarily by building tall buildings, but building more real estate, allowing people to buy into them. And I think this is an important factor. It's something in my view that there should be. I guess we want to increase supply, not necessarily gentrify. Right.
Right.
I think the problem with gentrification is it doesn't really increase the supply. Obviously, in some cases it's the way to go, but in many cases, if you can increase supply, that makes all housing more affordable. Right? Yes. Ultimately.
No, gentrification just causes displacement. Yeah. That's all that does. And I've seen that growing up here. I've lived here my entire life. And the area you live in now in McBurney Park, the joke is Skeleton Park. When I started in real estate, you wouldn't want to live within 200 meters of it. Now people want to pay an eye tooth to be on some of the streets surrounding it. And yet that, we see that now, and we see that, and of course, with the price of housing, that as people can't afford the center and then they start to move out to other areas, then those inhabitants that were there before now just keep getting displaced further and further out, right? So I don't disagree with you. I agree 100% that we need to create some sort of supply system or create some kind of policies that are going to help supply and not displacement, right? So, absolutely.
And I would even take it a little bit further, or maybe sound a bit... I'm not necessarily very conservative or anything, but there's a worry about having housing that's affordable. But what I was trying to say before is that even if you build reasonably high quality housing down in the center of the city, or increase this quantity of it, relatively speaking, at least, that should make other housing in the city cheaper, right? And it would inherently become more affordable,
right?
So you don't necessarily have to build purely low quality affordable housing for this to happen. I know that's what many people argue, but I find that a weird argument, and I find it hard to imagine that many developers are going to want to do that. So I agree with you. And there's a role for subsidized housing. I'm not saying that there isn't, of course, and government should assist in that because it's a necessity. There's no question about it. But I fully buy into that argument. That's insightful to say that. So, well, you know what? We'll leave it there, Hugh. If that and I again want to thank you. That was awesome, and I appreciate your time and appreciate your insights today. So that's phenomenal. It's true for me. I learned a lot from talking to you as well. What's going on in Kingston? So,
well,
I can see there's data and stuff, but I don't really know what's going on after that.
Okay. Well, if you have any other colleagues asking about real estate, just flip them my name and number. Then I don't mind. I'll have a conversation. All right. Well, thank you so much. You take care.
All right. Have a great day.
All right. You as well. Bye-bye.